And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Thursday, second best day of the week. That means Michael Lebowitz is going to join us today. We'll talk all about inflation. We had CPI report out on Tuesday. Today we have PPI, which is the producer price index. And, so we'll get into that. And, it's interesting. Everybody's still looking for inflation. It's like, oh, inflation's coming. But each one of the reports we get keeps showing, declining rates of inflation. So, today's another report. Will we get inflation today? Don't know. We'll talk about that this morning. And of course, at 7:30 this morning, Central Time, we'll actually see the report and what it says. There's certainly some probability that we might see an uptick in prices because of tariffs. But Barclays just came out with some analysis. So with the negotiations with China, Scott Bessent talking from Dubai yesterday, saying that basically they have a lot of good things going on and there's a lot of measures in place to make sure that we don't re-escalate tariffs on China. So they're hoping to get a lot of resolutions done with China over the course of the next 90 days, and then we'll have a kind of a final negotiation what tariffs look like. But Barclays came out this morning and did some analysis, and the average tariff rate right now is about 14% across the board. So between the negotiations with the UK, other stuff that's going on, and again, of all the countries that we impose tariffs on, we've only done 2 deals so far, UK and then working with China. Outside of that, we haven't heard from Japan, France, Germany, Zimbabwe, all the other countries around the world. We haven't heard from them yet as to what's going on. So, these deals are taking a lot longer to negotiate, which means that we're going to get extensions of this 90-day pause. So as we get to the end of the 90 days, we're going to extend that 90 days, another 90 days, as we're still within talks within these countries. It's just going to take a while to get these negotiations done. But outside of that, the relaxation of those tariffs is certainly helpful for the economy, and particularly at a time where we're seeing consumer debt delinquencies rise. We're seeing student loan debt delinquencies rise. And that's certainly putting some downward pressure on the economy, because as you start getting consumer spending to slow down, that's going to weigh on economic growth. That's disinflationary as of itself. Just simply can't buy as much stuff, less demand, you have less inflation. So we're going to see, this migrate out. Now, importantly, and we're going to talk about this in this weekend's Bull Bear report, recession risks are declining. Now, that doesn't mean we're not going to have slow economic growth, but now, just a month ago, all Wall Street analysts were out there saying, oh, we're going to definitely have a recession because of all these tariffs. A month later, it's like, hold on a second, no recession now. Definitely having slowing rates of economic growth, but recession risks still do remain very low right now at the moment. Doesn't mean that's not going to change, but we're going to discuss this in more detail in this weekend's Bull Bear report. This morning, Walmart has announced, basically came out and stated that they're withholding guidance. They had their report this morning. They're withholding guidance because of tariffs. And again, we've seen this from a few companies. They're not sure what these tariffs mean. And again, we're still in flux with a lot of these tariffs. Do we have tariffs? Do we not have tariffs? Are they 80%? Are they 10%? And that makes it very hard to judge what forward expectations are going to look like. So we've seen quite a few companies, not as many as expected. A large majority of the companies that reported earnings gave guidance, and most of them held guidance as to what they were. But we have had a few companies withhold guidance. Walmart now one of those. So probably going to weigh on the stock this morning. But that stock's has been performing well this year. So again, a bit of a pullback here in Walmart, really more of a buying opportunity than anything else. But just, they are kind of the bellwether for the average consumer. So it's worth listening to at least what they have to say. All right, with that, let's talk about the markets. Yesterday, markets continued to, kind of perform well. Ended about where we started yesterday. Not a lot of stuff that was going on within the markets. A bit of news coming out of Dubai on relative, deals. Yesterday talking about, they'll have deals worth $1 trillion. Now, that's kind of hard, when the entire GDP of Dubai is like 200 billion. But, it sounds great. We're going to have these massive deals. They're going to buy 160 Boeing airplanes. That gave a lift to Boeing yesterday. They're going to spend another $200 billion on defense technologies. That should help companies like Raytheon, Palantir, others that are basically in that space as well. So good news coming out of Dubai, of course, as President Trump is there. One thing weighing on the markets this morning a little bit is this meeting in Turkey. It was a peace negotiation to meet between Zelensky and others to help negotiate a peace agreement, or at least a ceasefire for 30 days. Vladimir Putin is not showing up to that, and so President Trump is not showing up if Putin isn't there to negotiate. So nobody's really going other than Zelensky and some envoys. So that's kind of weighing on the market this morning. The market was hoping to try to get some progress on a ceasefire deal. So that's going to weigh on futures a little bit this morning. But again, markets have had this huge rally really ever since these lows. So again, a bit of a pullback here. Just from that, we can assign a lot of headline risk to it and say, okay, this is why this is happening. But the reality is you've had this huge kind of short covering rally. We had really large short covering rally over the course of the last 2 weeks in particular. That's pushed this market up above all these resistance levels. So again, a bit of a pullback here, just a bit of relaxation. Markets are very overbought. Market pulls back again. Now we're at need to hold these kind of key critical support levels that we talked about some yesterday. That's still the process here. So again, this is the point, and I talked about a little bit about this with Charles Payne yesterday on Fox Business. This is the time not to get greedy. This is where investors start to go, okay, man, this market's just going to go up. I need to get more in. No, actually, this is where, remember how you felt down here at the lows and how you were acting about your portfolio at that point, and say, this is a good time. Take a little bit of profits, reduce your risk, rebalance, do those types of risk management protocols in your portfolio. This is the time to do it. This market is going to pull back here at some point, not dramatically. But if you don't raise some cash here, you can't buy the dip when it comes along, and you'll get a buyable dip here. Post-election years tend to have a decent rally in May and June. July tends to be weak, strong August. September tends to be weak, and then you have your October, November, December rally. So you're going to have a couple of opportunities this year to buy dips when this market pulls back a bit. Now, those are averages. But when this market pulls back, you've got to have some cash. So use this as an opportunity to look at your portfolio, reduce your risk, sell laggards, things that aren't working, move those out of the portfolio, reduce them. Things that have been performing well, rebalance those back to target. Put that cash on the sideline, wait for your next opportunity. Just be patient, you'll get it. But that's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Lebowitz. And we'll get into the inflation, what's been going on with that lately, why are yields rising, is this a change in the paradigm? We'll talk all about that. There's a lot of questions about bonds, bond yields, etc. So we'll get into all that this morning with Michael Lebowitz right here on the show. So don't go away. More of the Real Investment Show coming up right after this.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. It is, of course, Thursday as we get things underway. Lots of data out this morning. Retail sales for April is out this morning. Producer Price Index, that's the PPI we were just talking about a minute ago. That's out this morning. Core Producer Price Index is out this morning. So again, a pretty heavy economic day. I think also that Jerome Powell speaks today at some point. So there's going to be a lot of stuff to kind of push this market around a bit this morning. So again, we'll keep a watch on that. Walmart, Alibaba, Deere, Birkenstock, Applied Materials, Kava, and Take-Two all announced earnings today. We're wrapping up earnings season. These are just the last of the laggards. The one big report that's still sitting out there is NVIDIA. And that comes, I believe, next week. I think it's the 20th or the 23rd, something like that. Anyway, but that's the last big kind of Mag 7 report that's sitting out there, but that's going to be coming up here very shortly. So outside of that, though, one of the big questions that we've been getting by email and everything else over the last couple of weeks in particular is why are yields rising? So yields have been coming back up here. The last time we saw yields at this level, we were having the basis trade kind of blow up going on within the bond market. But yields have been kind of creeping up here just as of late. And yields had gotten below 4% just before tariffs were announced. Since the tariff announcements, yields have been kind of in this kind of volatile up and down range. They haven't really gone anywhere. They've just been kind of trading up and down within this 4% to 4.5% range. So it's a broad range for interest rates to move that much in a very short period. But that's what's been kind of happening lately, obviously, and that's got a lot of people that are trying to figure it out, concerned about where rates are going, and so this is it's always leads to a lot of debate, right? But that's what's been going on here. So this morning. A couple of things. Let's start with inflation because that's the kind of the key driver behind what happens with yields. Anyway, the latest CPI report didn't show any real sign of inflationary pressures. The year-over-year rate fell to 2.3%, well within the target for the Fed. If the Fed wants to claim victory at 2.3%, they pretty much can because you're back down to your 2% target. So no real pressure there in terms of inflation. Employment's been okay. Not any real concern there about the economy so much. So kind of what's today, of course, is the producer price index. A lot of concern here is that everybody kind of keeps hoping for, these tariffs are going to show up somewhere in this inflation data and we have this big surge in inflation, but we haven't really seen it yet.
Right. Tariffs, I think, are one angst for the bond market. And, Walmart today, one of the things that caught my attention was that the CEO said something to the effect that if there are going to be price increases, they could come later this month, early next month. So the question is, have we seen them? Will we see them? What will they be? So that's just creating some anxiety that we are going to get some inflation due to tariffs. But real quick, though, but that's the point I'm trying to get to, which is that if you take a look at CPI, nothing there. PPI we'll see today, maybe. But we did see a lot of price surge in the previous months, right? Because you and I were talking about we were seeing producer price indexes go up because they were front-running tariffs, and so now they've got the inventory.
but we didn't see that price inflation really come into the inflation report. So it's been interesting. There's lots of expectations for inflation to show up. It just hasn't shown up yet.
Right. It's the anxiety.
Yeah.
Right. I'm not saying that prices are going up necessarily. PPI will be a little more interesting than CPI because those are the goods that go into producing final products. CPI is the final products. Mm-hmm. PPI are the commodities and the other inputs to help make those. So in theory, if these companies were front running, PPI is probably where you would see it first. And if we see it in PPI this month, we should see it in CPI next month. But then it's a question of, can they raise the prices to the consumer? Like the Walmart executive is saying that they're going to raise prices, but if they raise prices and sales drop, they're going to lower prices. So it's not clear how much of those price increases, if there are some, they will be able to push through, and the impact it has on many other products. So I think potential tariff inflation anxiety is one cause. I think the other big cause, Lance, is the deficit. You know, we were promised the deficit was going to come down. Doge was going to cut billions and trillions, and it seems like that's faded. And if you look at the new bills that are kind of getting geared up, the reconciliation package, they actually have a higher deficit than we were running beforehand. So it's what went from a very positive deficit reduction story has kind of faded, and we're kind of back, at least as it stands today, we're back to our old ways. So, you know, you kind of put all this together. You have tariffs, which should impede global trade, which to some degree impedes the need for dollars. At the same time, the government needs to borrow more dollars. And where does that leave the government trying to fund it? And I think that comes down to us. Well, it's gonna hurt the economy because we have to pay for it.
But that doesn't really hold water. You know, that's been an excuse that's been running around for a while about, yields are going to go up because of the deficit. But that thesis doesn't really have any value to it because we've been running a deficit since 1980 and yields have been coming down ever since then. So
Lance, I'm telling you the narrative.
I agree. I just want to debate the narrative with you because that's one of the issues is that, in the short term, bond traders are, can short bonds and they can push yields up temporarily because of, for whatever reason. They're doing it to make money, right? The trade right now is to short treasuries because I can make money with it. That's the momentum. It's the direction of the market. So that's easy to do. So we have to assign a narrative to that. And so it's for the fear mongers, it's the debts, it's the deficits. But again, just a brief look at history just shows you that actually yields follow the deficit because as the deficit gets larger, yields come down because you're eroding economic growth.
Well, that's true. So, like all markets, we have to disentangle reality, history from narratives. And there's a lot of bearish narratives floating around. The other one, I was talking to a friend who works for one of the big banks in New York, and he said the banks are, without saying it, he kind of alluded that the banks are somewhat behind this rise in yield because they're trying to get the Treasury, the regulators, to push down these SLRs. These are supplementary leverage ratios.
Right.
And those were brought in after 2008. And it basically means they can't leverage as much as they would like to, i.e. they can't buy as many treasuries as they would like to. They can't make as many loans.
Right. This is a really important aspect you're making, and you're throwing out some terms that are just flying right over everybody's head. Prior to 2008, so we run on fractional reserve banking. In other words, if I bring in $100 as a bank, I can loan out multiples of that. And prior to 2008, we were loaning out 20 times that ratio. And of course, that's a lot of leverage, when you're running that kind of bank. So when the financial system blew up in 2008, one of the perceived fixes of that was to lower these leverage ratios to like 10 to 1. And so I can loan out for every dollar that I bring in, I can loan out $10. And that was supposed to be the fix. And of course, we also repealed FASB Rule 157, so we don't have to mark down assets. We did a lot of other stuff to really bail out the banks at that point. But this is what Mike's talking about now is these leverage ratios. What the banks want is they want to be able to loan out higher leverages. So in other words, instead of 10 to 1, I can go back to 20 to 1 and I can make a lot more money with that, obviously.
Right. So one way to do that is to kind of force the Treasury to have a need. Who's going to buy their debt? Right. That's if that's what the market's fretting about, who's going to buy their debt? There's one easy answer: the banks. But the banks are saying we can't buy anymore. You've handcuffed us. Take the handcuffs off. So odds are, as yields approach 5%, the odds of those handcuffs coming off are increasing rapidly. So it's quite possible the banks too are, as my friend alluded, but wouldn't really tell me, are kind of okay with this move in yields. But Lance, keep in mind, there's a lot of natural buyers up at these levels. Insurance companies, endowment funds, foreign sovereign funds, a lot of individuals, corporations would love a 5% yield. A lot of endowment funds and pension funds have target rates around 5%. They can basically lock in a risk-free yield at 5% and call it a day, go on vacation.
Right.
So that's a big deal. And you throw a little bit of leverage on 5%, and now you're talking 7-8% with very little risk. So, and that then poses problems for the stock market the longer this goes up, because if you can get 5% or 7, 8, 9% with a little bit of leverage, what are you doing in stocks that historically yield 7, 8% and have a lot of risk?
Well, again, but we're in a stock market that yields 20% every year. I mean, don't you know that?
Course.
I mean, that's where we are now. So, and throw a little bit of leverage on that. And as we were talking about yesterday, you just wrote an article on our daily market commentary that was pinned out yesterday. So if you go to our website, realinvestmentadvice.com, and click on the daily market commentary, Danny and I discussed that new company that's now offering 4 times leverage on your 401k. So if I can slap 20% a year, 4 times leverage, it's all good as everything goes up, right?
Right. It's that article is crazy, and it's basically what they're allowing users or clients to do is apply 4-to-1 leverage on 401k plans. If you apply 4-to-1 leverage, a 20% decline, whether it's stocks, private equity, whatever it is, your value goes to zero.
Yeah, so the margin calls are a bitch. That's the bottom line.
Leverage works both ways.
Exactly.
It gets you 20, 30%, and a smaller decline gets you zero and gets you negative. So the question is, who pays when it's negative? And that's the article didn't mention that for some reason.
It never does. There's never any downside risk to the markets. I mean, come on. We just had a 19.2% correction peak to trough, and it's gone now. So,
right.
These are just blips. Anyway, we'll come back. We'll talk a little bit more about inflation, interest rates, kind of what happens next for the bond market. Getting interesting comments in the chat as well this morning, talking about markets overvaluations and the people refer back to the Buffett Indicator. There's a problem with that indicator. We'll talk about that as well with Michael Lebowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm a little disappointed. I was expecting Crocodile Dundee to come back from this trip and have alligator tooth necklaces or some tribal tattoo, where he was adopted by some tribe.
The Real Investment Show podcast.
You don't know what I'm wearing underneath the suit.
Same show, your schedule.
You didn't come back married to some tribal princess or something?
No, I did not. Yeah, I can barely keep up with one, much less multiple.
At realinvestmentadvice.com.
They must have some really good time management.
Exactly.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just talking a little bit about bond yields and inflation and, kind of what's going on with markets. And you have to understand, in the short term, over the course of a couple of months to a year, even a couple of years, markets are driven by trading dynamics. It's, how many buyers do you have? How many sellers do you have? Who's short? Who's long? That's what drives prices. Prices are always driven by supply and demand, right? But longer term, things like stock valuations, as well as interest rates, those follow more of the economic dynamics of the economy. Because, again, yields can only go so far in one direction before they impose a brake on the economy. If they go too far in the other direction, they overstimulate the economy. Then you get adverse reactions because of that. So, again, you have these longer-term dynamics of economic growth, inflation, wages, those type of things, those set yields longer term. And so again, in the short term, you can have a lot of volatility. And so if you're trading bonds in the short term, I'm going to buy bonds today and I'm going to expect yields to come down. So if you look at a bond chart today right now, yields are very oversold. And so this would be a great time if you want to step in, you buy bonds here, you get a bounce in, you get yields to come down, a bounce in bond prices on a technical basis. You sell the bonds, you make money, go home, right? And that's what's happening in the trading markets all day long right now. But if you're buying a bond today, then you're going to lock in a rate of return. And over the course of 10 years, inflation, interest rates, economic growth are going to continue to slow because of the overall dynamics of the bond market, of the debt itself, as Mike was talking about. We have increasing levels of debt that erodes economic growth, that will bring down inflation, that will bring down the interest rate on bonds, which means your bond price will go up. So as you approach maturity on that bond, you should have a capital appreciation at some point along the way. Now, if you hold it till maturity, you just get your principal back plus interest. So that's a different story. But those are long-term dynamics that affect prices of the bond market over time. So the question is really framing your, and this is what we call duration risk for your portfolios. Like, what is your time frame? What is your holding period for an investment? And so if I'm trading or if I'm investing in bonds, as an example, or stocks or gold or whatever else it is, it doesn't matter what it is, you have to match the duration of your investment time horizon to what the expectations are for that asset. Because again, it's all fine and dandy until things don't work out. And and then all of a sudden you're going, well, I was only going to hold this for a year and it went the wrong direction. Okay, well, you've got a duration problem because you bought a 20-year asset for a 1-year holding period. So you have to think through these things within your own portfolio and think about the risk that you're taking when you add an investment to your portfolio. It's one of the big mistakes, and we talk about this constantly, is about psychology of investing, is that we buy stuff. It's like, oh, this thing's going up, I'm going to own this, forever, until it stops going up. And all of a sudden your time horizon goes from 20 years to a year, right? So I never expected it to go down. Well, things go down, right? And so the question is how do you navigate that? How do you manage that risk? So with that kind of in mind, Mike, what is kind of the expectation? And again, this has been a lot of the questions. A lot of people are trying to figure out, do they want to buy bonds here? Or not. And so I guess the question to you is kind of how are you thinking about navigating bonds in this type of environment right now?
So, on a short-term basis, like you said, I think that's a huge point, Lance. Are you a trader or are you an investor? Mm-hmm. From a trading perspective, we're looking at our technicals. We're looking at, in the bond market, in the stock market, nice round numbers always attract buyers or sellers. We're coming up on 5% for the 30-year, 4.50 for the 10-year. Those will attract buyers. We're also very oversold on price, very overbought on yield. So from a technical perspective, if you wanted to trade the market, again, this may be for 2 weeks, 3 weeks, 4 weeks, you should expect some sort of bounce here. And any kind of news from the Treasury or a weak PPI potentially, or retail sales could help that. Tariff agreements could help that. But if you are an investor, now we're talking about years. Do you want to lock in a 4.5%, 5% yield for 10 years, for 30 years, for 20 years, whatever it may be? That analysis is very different. You're looking at fundamentals. You're looking at what's the rate of inflation, what's the economic growth rate, and how do those play into the yield? And that then becomes a question is, are we going back to the economy the country was before COVID, or are we in a completely new environment? And I think the people arguing that 5%, 6%, 7% yields are going to be the new norm, like Bill Gross, like the guy from Double Line, forgot his name. Gunlock. Yeah, they think we're going to 6%, 7%, 8%. We've talked about this a million times, but are we different from where we were pre-COVID? And there are differences, certainly, but it's hard to argue things have vastly changed. So, you have to understand what you are, and then you have to understand the technical or fundamental backdrops behind those positions. And if you're a trader and the bonds are going against you, don't rely on those long-term macro fundamentals. Rely on your trading tools. And are we overbought where it's got to bounce, or can it get more overbought or more oversold or whatever it is? So it's very important you can mix them, but be careful mixing them too closely, because you'll get stuck in a position you don't like, and it may take 3 months or 6 months to get back to where you thought you were going to get back in 2 weeks.
Yep. And again, that's such a key point, because again, as the biggest mistake that investors make is they go into something and it's all fine and dandy when they go into it and they're like, oh, this is great, this is going to happen and this is going to be my outcome, whether it's a stock or a bond or whatever it is. And all of a sudden, everything goes against them, and all of a sudden that long-term time horizon becomes very short. And then and all of a sudden now you're panicking because now you're losing money and you're trying to figure out what do you do now, but you've forgotten what your long-term thesis was, why you bought this asset to begin with. A lot of people were piling into gold right at the peak of the gold market, and we were talking about, hey, gold's very overbought here. It's going to have a pullback, and so be patient here. You're going to get a pullback in gold to support, and you've now had a decent pullback in gold. But there's a lot of people that bought gold right at the peak. They're now underwater trying to figure out, well, is gold going down more or is it going back up? What's it going to do? But this is every asset. This happens in every asset class, whether it's stocks or bonds or gold or commodities, whatever. You have these price volatilities that occur over time. And the mistake that investors make is they go into this with a long-term thesis, but as soon as something goes against them, all of a sudden it's a panic to try to figure out what to do now. And you completely forget about why you bought this in the first place. Whether your thesis is right or wrong is a different story. You've got that's one of the other problems that investors run into is they come up with a faulty thesis and then they can't figure out why their trade didn't work the way they thought it was. I'm short the market because market's overvalued, that it's going to crash, so I'm short the markets. And then that doesn't happen, and so now your thesis was bad going into that to start with. So you just set yourself up for a bad position. But to Mike's point, very important to understand what your time frame is, and then apply the appropriate tools for that time frame. And then don't keep adjusting your time frame. Your time frame's your time frame, whatever that is. Stay with that, and then adjust your tools.
Lance, gold is a great example of what's going on. How many people bought it? In the last 2 months on the thesis that the dollar is going away, that the world is changing, that it's going to be gold, and you got to insure yourself and you got to have gold. And that's fine. If that's your thesis, that's fine. But that's a 5, 10, 20-year thesis. That's not a what's going to happen over the next 3 months. Because like Lance said, the technicals, how overbought, how much momentum is there? Is there a lack of momentum? Will drive that price. So if you bought it at 3,500 and what is it now, like 3,100?
Yeah.
And you bought it on that long-term thesis, who cares? Who cares? If your thesis is right, it's going to be multiples of 3,000.
Right.
So
you buy
but
more.
If you're a trader,
yeah.
If you're a trader, you should understand those technicals and get out because it was grossly overbought and due for a significant pullback. So sorry.
And Mike may die here in a second, so we need to get everything out of him we can.
Bottom line is understand what you are. Are you investing? Are you trading? Is it a hybrid of both? But don't turn trading positions into investing positions because you got stuck in them.
Right. And that's the big mistake that investors do is they wind up holding on to losers and laggards because they're just hoping they get back to even rather than just saying, okay, got to let this go and then we'll come back to it later. And, when things improve. But real quick, just to sum up on interest rates and bonds and where things are, because this has been the big driver. Again, you have to look at your portfolio and say, why do I own bonds in my portfolio to begin with? And if your whole reasoning is I'm buying bonds because I want them to go up in price, that's not a good reason to own bonds. You own bonds in a portfolio because you're trying to mitigate portfolio volatility over time. And lots of articles out, the 60-40 is dead, blah, blah, blah. Well, it's interesting that at the beginning of this year is a good example when we had a lot of market volatility, bonds were holding up very well, actually doing very well relative to the bond market. So there's been plenty of times that negative correlation steps in and helps mitigate portfolio volatility so that you can sustain your ability to stay in your portfolio and keep it allocated to markets and let it grow over time. That's a reason to own bonds. If that's not your reason, maybe you shouldn't own bonds to begin with, because maybe if you're just trading them again and you don't understand how to trade, don't own bonds because they're not something that are well understood by most investors about how they work, how they operate, what drives them long term. So manage your, just don't own bonds, just own stocks. You understand, buy, as Peter Lynch once said, buy what you know, invest in what you know, and you'll do better over time. All right, come back. I want to talk about the Buffett Indicator. Lots of comments this morning about valuations in the markets and why a coming crash is right around the corner. We'll talk about why that's been a flawed thesis for quite a while and probably is going to continue to be. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So chat is very busy this morning, and there is so much false information in the chat. If you're in our chat, A, stop spreading false information about a variety of things when it comes to markets. But B, don't listen to the chat because there's a lot of false information going on in the chat this morning on multiple levels. But one thing that I did want to talk with you, Mike, because we've written about this before, is lots of conversation about valuations in markets. Markets are overvalued, so they're going to crash. Markets are overvalued. That means they're going to have zero return over the next decade. The problem is really threefold. And one in particular, we're talking about the Buffett Indicator to a large degree. And the Buffett Indicator, of course, near 2 times market cap to GDP. And, the problem with these valuation indicators, and it's really the same conversation that we just had with bonds, is that these valuation indicators are very long-term in nature. In other words, they can say markets can be overvalued for a very long time before it matters. And then it's easy in hindsight to go back and say, yeah, see, the market was trading at 23 times earnings back in 1971, and then you had the market crash in 1974 that reversed the valuations. Well, the problem is markets were overvalued for a long time before you got to that peak, right? And then markets were way overvalued going into the dot-com crash before you finally got that correction. So the problem with valuation indicators goes back to the same issue as we were talking about with bonds, which is time frames. And, again, you can look at the peak of the market in 1999 and say, yeah, see how, markets were trading at 42 times earnings on a trailing basis in 1999. And yep, they crashed right after that. Well, yeah, but people were talking about them being overvalued at 20 times earnings, at 23 times earnings back in 1990. And so 10 years later, the market finally crashes. And how much money did you lose? Or I shouldn't say lose, maybe you didn't lose anything because you weren't in the markets at all. You had gotten out of the markets because of the valuation indicator. You got out of the markets, you didn't lose any money, but you missed out on all those gains that were made going into the market peak. And it's the same thing now. The Buffett Indicator has been above 1. And again, the important thing about the Buffett Indicator is that when the market trades above 1 times market cap to GDP, that's the market cap of the stock market divided by economic growth. When it trades above 1, market's overvalued, you should not be invested. It just says that, and this is the belief, is that just means you're on very low to negative returns over the next period of time until that valuation reverses. Well, the Buffett Indicator crossed 1 back in 2010. So here we are 15 years later, we're at 2 times and the market's still going up. And so the problem with this indicator is that says, historically, when you have an overvalued market, your forward returns are going to be lower. And it's easy in hindsight to go back and look at the peak of these indicators when they occurred and say, yep, there was the peak of that indicator. And over the next decade, returns were near zero. But the problem is you don't know where the peak of that indicator is at this particular point in time. It may be here. It might be 3 times market cap to GDP before this market finally peaks. And so it's important to understand what valuation indicators tell you is really more about investor sentiment than it does giving you a market timing device. Valuation indicators are a terrible market timing device, and you should never use them that way. It's more just of a measure of just telling you, yes, you are overpaying for assets. The whole market is willing to overpay for assets. And until that changes and something occurs, then that's going to matter. But the problem is you don't know when that's going to matter. Mike?
With the composition of it. So market cap over GDP. Well, the GDP of this country in the 1970s was different than it is today. Foreign trade, globalization has become a huge deal. So if you're comparing what a company can sell in 1970 to a more restricted market, to a much bigger market, that's a problem right off the bat. So that ratio should be rising with globalization over time. The second thing is that we're not a manufacturing nation like we were in the 60s and 70s. We have become much more of a tech innovative. We've gravitated towards companies with higher growth rates, higher margins, more ability to make money. So it's those magnificent 7, really the top 20 stocks that are driving valuations. And we talk about some of them like NVIDIA and Google. They actually have valuations that are below the market. So you have to think about, is it a comparable statistic? And I think it is still a very valid statistic, don't get me wrong. And it is telling you the market is overpriced. But you can't just look at it and say, oh, it's 4 times overpriced because it's, what is it, like 2.5 now?
A little over 2.
Over 2, where it should be 1 or below according to Buffett's rules.
Right.
And I think that's true. That this also comes up when we look at foreign price to earnings for foreign countries. If you're looking at like a broad index, comparing it to the S&P 500, that's not apples to apples. Again, our S&P 500 has more tech, more higher margin industries, more growth industries than other countries. So when valuations are incredibly helpful, like you said, Lance, are not a great timing tool, but you also have to take them with a grain of salt and really understand what's beneath them as well. So, yes, we're overvalued, and we're not just overvalued on that. There's a lot of statistics telling us we're overvalued, but who's to say we can't get a lot more overvalued? And, again, there's nothing that says today's a day that we've hit the peak. Because if you go back over the last 20 years, we've hit that peak almost every day for the last 20 years.
That's right. And again, this is, but and again, this kind of goes back to our conversation about, everything when it comes to investing is, these measures, these tools, all of these things, they have value. I'm not discounting the value of the Buffett Indicator, but if Warren Buffett was so concerned about the Buffett Indicator, he would have no money invested in stocks. Yeah, he has a lot of cash on his books right now, but if he was really worried about the valuation, he wouldn't own any Apple. He wouldn't own any Occidental Petroleum. He wouldn't own any of those in theory, right? Because you're going to have no returns on those investments over time. But that's not that's not the way to invest. And and again, are we overpaying for assets? Absolutely. But that doesn't mean that every asset is overvalued in the stock market. What Mike and I have talked about, recently. You buy NVIDIA right now at 1.2 times PEG. You can buy Google at a 15 forward PE. There are undervalued assets in the markets. Just because you look at a global market and say the market in general is overvalued, it doesn't mean that every asset or every investment, likewise, is also overvalued.
Well, let's look at his biggest holding is still Apple, right?
Right.
I just pulled up PEG ratio. So it's price to earnings divided by growth. And that tells you, it basically normalizes the price to earnings for growth. So if you have a high PE, but a high growth rate, that's okay. Apple has a PEG ratio of 4. NVIDIA is 1.5. Google is 1.38. Meta is 2.5. Microsoft is about 2.5. Tesla's 9. Amazon's 2. So of those kind of magnificent 7 stocks, he picked the one with the second highest PEG ratio. So his indicator is telling you the market's very overbought, but his largest holding is in one of the biggest, top 3 biggest stocks with a PEG ratio that's 2 times most of the other large, the mega cap stocks. So, Buffett also has a 100-year time frame. Buffett's going to retire, but Buffett's time schedule isn't yours and mine. We don't have a set 20, 30, 40 years in which to invest our money and hope that we started at the right time and ended at the right time. Because if you start at the wrong time, the returns can be very different than if you start if you start in 2009 versus 2007, in 1999 versus 2003, those return differentials are huge. So, again, Buffett, extremely smart man, really respect him. But there's a lot to investing other than looking at a few key indicators and just determining that you can't get into the market or you can't get out of the market.
Well, and that's really the key thing is just, there's lots of conversation going on about inflation from the 70s versus today. And yes, government indicators, there's lots of arguments, there's lots of debate about, are government indicators rigged, right? The inflation number's rigged because in the 80s we used a basket of goods to measure inflation. Then in the 90s the Boston Commission changed it, and now we use these other measures. Yeah, inflation's rigged. But it doesn't matter because the markets don't care about what inflation was back in 1980s or how we calculated it. The markets only care about the economic data that's printed today. If the employment data is good, whether or not you agree the employment data is rigged or not, doesn't matter. That's what the market looks at. That's what investors are looking at. So you have a simple choice here, which is, do you want to make money or not? And if you want to make money, then get on the same page as the rest of the market and understand what they're looking at and how they're managing money and how they're investing. Or you can live off the book and try to fight the tide, so to speak. But that always tends to be a losing venture in most cases. So again, it's just got to make a choice is what you want to do. Anyway, thanks a lot for joining the show today. Mike, appreciate you so much. Be back tomorrow with Richard Rosso, of course, for Financial Fitness Friday. Y'all have a great weekend. See you back here on Monday.